This is Chris Lewis, the head FX and strategy trainer. I'm taking a look at a strategy that you've undoubtedly heard of multiple times. It's trading double tops and double bottoms, but I'm going to show you how a professional does it. And over the last 15 to 16 years I've been trading, I've learned that a simple double top by itself is not reason enough to short, nor is a double bottom reason enough to go long. You need to have a multiple listing of reasons to take a trade. And in this video, I'll first explain what a double top or double bottom is, just in case you don't know. And then I'll show you how a professional adds everything that they can to the position and the setup in order to make sure that the odds are with you. Okay, so first things first, I will explain what a double top or a double bottom is. This is a double top. Now, ideally, you have an attempt to break through a level, a pullback, and another attempt that fails at a very exact level, but that doesn't happen very often. But as you can see on the Australian dollar against Swiss franc daily chart, we are looking at a difference of about 10 pips. That means that basically this area right here, and I would use the big figure, the 0.61 level, has offered enough resistance to form what would be considered a double top. We've tried to break through twice and we failed. So the question is, how do you take a setup like this and make it work for you? Well, nothing's perfect, but there are a few things that I've learned. Number one, you look for the next big figure, where it's at, or obvious support or resistance, depending on what the situation is. In this case, we'll just use the 0.61 level. So that's your stop loss. That's assuming that you take it right away. I would not do that. So I will leave that line up to tell you that if we do break above there, after seeing this setup, something has radically changed in the market. An actual entry, and there are 100 million different ways to do this, but an actual entry would be after we break down below the initial pullback. Sometimes you'll refer to a double top as an M pattern, and you can see exactly why. So it was on this candlestick that the market broke through that, and it made a lower low. So you have several things going on at the same time. You have an obvious resistance level that has held the market at bay. You've had a pullback that ended up being a swing low. And then in this case, you had a pretty sizable candlestick. So that tells you that there's real momentum. There are other things you can look for. So for example, you could put something like the moving average crossover, moving average convergence divergence indicator, or the MACD, and you can see that at this double top, we had divergence. That means the momentum was not keeping up with price action. And a lot of times that's a potential sign that things are about to get bad. So once you enter this, what are you looking to gain? Well, the general rule is that the height of the M in this circumstance is your target. So you're looking to get down here. Now, look at where it ends up. It ends up at a place where there's been obvious support before. Makes a lot of sense. This all ties together quite nicely. Now, there are a plethora of ways that you could put your stop loss. You could put your stop loss halfway. So that means you're automatically doing a 2-to-1 trade. You are trying to gain 2 for every 1 unit that you risk. You could also put it at the top, in this case, of a very impulsive candlestick. This was a very negative candlestick. So if we take that out, makes sense that maybe something had changed. Remember, when you look at candlesticks, you are watching what the market is telling you, and hopefully you're listening. You can think of each one of these candlesticks as a potential chapter in a story. In this example, I have the US dollar against the Swiss franc. I would show you right here, right around the 0.91 level, you will notice that there has been a lot of support during this time frame of about 5 months. Notice that we bounced from here, pulled back, bounced again, pulled back, and took off. So in this area, you actually have a bit of a double bottom or a W pattern. It's a small version of it. But notice when we take off and we break above there, we had pulled back a little bit, found support, and then really took off. So what you're looking for here is the measured move of the height, in this case, of the W pattern. And we clearly got that. Also notice that it's an area that was the latest swing high. So it all ties together quite nicely. Let's start to ask questions of the oscillators. So in this case, as it is a sideways market, the stochastic oscillator becomes one that is a little bit more interesting. We crossed right at the oversold condition, right in the middle of this, showing that momentum was picking up to the upside, and we did, in fact, take off. This is a short-term trade, but it was set up really nicely. There was an obvious area of support, so you clearly would be looking to get long at that point, aiming for the last swing high, and perhaps putting a stop loss below the 0.91 level. And let's take a look here at the NASDAQ 100. Notice how the area right around 11,000, and you would have to be a little bit sloppy with how you measured it, but right around 11,000 was attracting a lot of attention. That being said, take a look at this very complicated double bottom or W pattern, if you will, and how it played out. Now, the thing is, this actually ran for quite some time. This was about 3 months or so. But this shows a real resiliency of the market. Now, with indices, and especially the US indices, it's worth noting that they do tend to go higher over the longer term, 90% of the time anyway. So, as a general rule, I don't short indices. They're just not designed to fall. And what I mean by that is they're not equal weighted, so a handful of stocks can move the entire thing. Notice this area here was your resistance. We broke out of it, pulled back, tested it, and took off. So you really could have gotten into it here, and you would have had some issues initially, but you eventually broke out. Or you could have got into it here when we cleared this candlestick, or you could have got into it on the pullback. The stop loss could go a little bit below 11,000. There's a little bit of art to this. You could just say, hey, this swing low here. I don't think you need to give it that much. But on the daily chart, you can see that we did, in fact, not only take off to the upside, but at this point in time, we managed to hit our target and pull back from it. So time and time again, you'll see that with technical analysis. The measured move suddenly gets hit. Now, the reason I'm showing you mainly higher time frame type stuff is because this does have more efficacy on the higher time frames. The NASDAQ is a little bit special story because, quite frankly, it goes higher over the longer term most of the time. So that's why I don't, like I said, look to short this market. You could have put a stop loss underneath the 50-day EMA if you wanted to, or you could put it all the way down here. It really comes back to how you wish to trade and what your risk tolerance is. Finally, the U.S. oil, West Texas Intermediate crude oil market, formed a double top right here at the 93.80 area. Now, what I like about this is that it is a continuation of the downtrend. It isn't some massive double top. It's a continuation of the downtrend, and it tells you, more likely than not, we are going to see a continuation, in this case, of the overall trend. Notice how that's dropping. That's the 50-day. Now let's go ahead and put the 100-day, and we'll just see how that plays out. And you'll see that it followed the 100-day very closely. One thing that you'll learn about commodities is they do tend to follow technical indicators quite well. They do tend to be very technical markets. Furthermore, notice that 93.80 or so, give or take a nickel, was massive support back here in March. And now we're talking about the fall. With that being said, it's another situation where you are looking for the bottom of, in this case, the M pattern. That's what we got. And we broke down below it. You could have put your stop loss again in the middle or back here. It really comes down to what you think. This measured move, we clearly hit that almost right away after we tested this for resistance. And that's another thing too. I would point out that we formed a shooting star when we tested it. So that was your second chance to get involved in this market. If you were to put your stop loss right in the middle, as per the initial example, that's an automatic 2-to-1 trade. Do I worry about that as much when I go with the overall trend? Maybe not, but I will tell you this, that typically when you go with the overall trend, you don't generally worry about your stop losses too much, although some random announcement or geopolitical issue in the case for oil could come into the market and it stops you out. There's really nothing you can do about that. With proper money management and stop placement, as well as target placement, you'll find that the double top and the double bottom patterns are some of the favorite ones of traders, and you'll find out why that is very quickly. It's very mechanical. It's very easy to spot. Higher time frames generally do better than shorter time frames, although I know some people that use 5-minute charts to do this. But at that point in time, the accuracy of your support and resistance levels from maybe the higher time frames have to come into play. So on a 5-minute chart, if I see a double top and it's at like 1.10 in the euro, and I see that that's an area that's been massive resistance multiple times, I might take it. But as a general rule, this is more or less a mechanical system that you can set and somewhat forget.